What if I told you the same thousand a month into the same whole life policy with the same insurance company could give you 110,000 you can borrow against by year 9, or leave you underwater for 20 years? Same premium, same carrier, same person. The only thing that changes is how the policy is structured. Most agents have no idea how to do it right. Dave Ramsey calls whole life a scam, and for 95% of policies being sold out there. He's correct, but the problem isn't whole life, it's the design. There are 3 ways to structure this product, and they produce completely different results. One of them proves Dave Ramsey right. One of them is what agents default to when they think they're doing their job. And one of them is what serious wealth builders actually use. I've got a comparison sheet in the description so you can follow along with real numbers. All 3 designs are modeled as pay to 100 to keep everything standard. Shorter pay periods exist, but we're holding the structure constant so the comparison is actually fair. The first design is what you've seen advertised during daytime TV. No medical exam, guaranteed acceptance, usually marketed as a way to cover funeral costs or leave a little something behind. That pitch works because it's easy to sell to people who can't actually qualify for anything else. The death benefit is fixed from day 1 and it never grows. Cash value is essentially 0 for the first decade, sometimes longer. And the internal rate of return on these policies is deeply negative, well into the policy's life, worse than either of the 2 designs we're about to cover. Now, commissions on final expense policies are high. That's not an accident. The carrier has no medical underwriting, so they're taking a real risk and they price the product accordingly. The agent gets paid well to move it. That's the incentive structure and it shapes what gets sold. This is the product that gave whole life its reputation problem. When Ramsey says whole life is a ripoff, this is what he's actually describing and he's not wrong about it. If this was the only version of whole life that existed, you'd be right to avoid the entire category. But it isn't. And the next design is what most agents reach for when they think they're doing better. The traditional design gets sold as the responsible option. The agent runs the numbers to find the maximum death benefit the IRS allows before the policy becomes a modified endowment contract, a MEC, and then fills it with base insurance. Big death benefit, standard structure, looks clean on paper. Here's what the actual numbers look like on $1,000 a month for a 45-year-old male non-smoker. Initial death benefit is $628,479. Year 1 cash value is 0. You've paid in $12,000 and you can access nothing. By year 5, you put in $60,000 and you're sitting on $29,344, less than half of your money back. In year 9, $108,000 paid in, $74,420 available. Still $33,580 underwater. Year 10, $120,000 paid in, $86,768 in cash value, still more than $33,000 in the hole. Break even on this design doesn't happen until year 20. The internal rate of return by year 10 is negative 5.99%. By year 20, it barely crosses 0 at 0.02%. The peak internal rate of return this design ever reaches is 1.85%. It never crosses 2%, which means for the first 2 full decades, a basic savings account outperforms it. This design carries the highest commission of the 3. The more base insurance means a larger first-year commission for the agent. And that financial incentive is a real reason it gets defaulted to even when it's not actually what the client needs. To be clear, if the goal is purely estate planning, passing a large fixed death benefit to heirs and cash value access is never the point. This design makes sense. The math looks different when liquidity isn't the objective. The problem is that the agents default to this structure even when the client's actual goal is access and flexibility. They're selling the wrong tool for the job. The third design is built for a completely different outcome, and the numbers actually show why. The right design is the paid-up edition loaded blended design. Same $1,000 a month, same 45-year-old male non-smoker, same carrier. The structure is what changes everything. In a paid-up edition loaded blended design, roughly 20% of the premium buys the minimum base policy the IRS requires to keep it out of MEC territory. And that base policy gets stacked with a 10-year term rider to hit the death benefit threshold. The 80% goes directly into paid-up editions riders. That's the 20-80 split. If the goal is to push even more into the cash value, a 10-90 split goes farther. But 20-80 is where most of these designs start. Now, here's why agents don't sell this version as often. Commission is calculated on the base insurance, not the paid-up addition rider. So in a 20-80 design, the agent is earning commission on 20% of the premium. The traditional design, all base, means commission on 100% of the premium. That gap in compensation is real, and it shapes what gets presented to clients. It's not always intentional, but the incentive points in one direction. So what does the paid-up addition rider actually do? Each paid-up addition is essentially a tiny, fully paid policy being dropped inside of your main policy. Because it's already paid up, it converts to cash value almost immediately. That's what separates this design from the other two mechanically. Money moves into accessible cash faster because of what you're actually buying with each dollar. Pull up the comparison sheet if you haven't already, because this is where the numbers get worth staring at. Year one cash value in the paid up edition loaded design is $9,223. Not zero, not negative. Actual money you can borrow against. Compare that to the traditional design where year one is a flat zero after $12,000 paid in. Year five, $55,057. The traditional design is sitting at $29,344 at the same point. Less than half. You're looking at nearly double the accessible cash value on the same premium dollars. Year 9 is the one that matters most for this comparison, $110,619 in cash value against $108,000 total paid in. That's break even. The policy has crossed the positive territory while the traditional design is still at $33,000 underwater. That's an 11-year gap between the two designs hitting the same milestone on the same premium. Year 10, $125,890. You've paid in $120,000 total, and you're sitting on more than what you put in, while the all base design is still in the hole by more than $33,000. By year 20, the internal rate of return on the paid up edition design is 2.6%. The traditional design is at 0.02% at the same point. That's not a close race. 0.02 is essentially zero. The paid up edition design is producing 130 times more return on identical premium dollars at the 20-year mark. Now, 2.6% might not sound like a home run until you factor in that's a tax-free internal rate of return. If you're in a high tax bracket, you'd need a taxable bond or CD paying close to 5% just to net the same amount after taxes. That's a hard number to find right now without taking on real credit risk. The whole life version of that return is completely out of the market, guaranteed to grow, and the internal rate of return can even go higher if you front load the policy. The death benefit starts lower, $294,960 at issue versus $628,479 in the traditional design. But because paid up editions stack every year, that number climbs. By age 100, the paid up edition design reaches $1,271,410, which actually passes the traditional design's $1,214,364. The design built for cash value access ends with a larger death benefit at the end too. One more structural thing worth knowing, the paid up edition rider runs through age 80, then it stops. But the base policy is still a pay to 100 structure. Same as the other two designs in comparison. After age 80, the annual premium drops from $11,800 down to $2,100 for life. Total lifetime outlay of the paid up edition design comes to $457,508. The traditional design costs $660,000 over the same lifetime. You're paying less, getting more cash value access, and ending with a larger death benefit. For older clients or anyone sitting on a liquidity event, business owners coming off a sale, anyone with a lump sum ready, there's one more tool worth knowing about. You can front load the policy at the start with a single dump in, one lump sum right up until the MEC limit on top of your regular premiums. That additional capital starts compounding from day one, and it pulls break even down to year 2 or 3 instead of year 9. The internal rate of return jumps because you put more money to work earlier in the policy's life. If timing and acceleration matters, that's the lever to pull. The comparison sheet in the description has the break-even columns and the internal rate of returns side by side. Look at those two rows. The numbers make the decision without any sales pitch attached. Most people think the debate is whole life versus a 401k. It isn't. The real choice is between the wrong whole life design and the right one. And most people are buying a policy right now don't even know which one they have. Dave Ramsey is right, just about the wrong policy. The comparison sheet is in the description if you want to see how a properly designed policy looks like built around your actual numbers. There's a link in the description. And if you want to see the math on why a 5% return in a taxable account is actually worse than what you get inside whole life, watch that video here.